From the world of business, after years of rapid expansion fueled by state subsidies and aggressive price cuts, dozens of Chinese EV makers are now facing a tough reality. Mergers, consolidation or shutdown could be the central theme for the industry in 2026, with cash drying up, government support that is fading and only a handful of big players who are still making money in the country. While China's electric vehicle industry is now showing signs of strain after central government subsidies ended in 2022, many weaker EV makers survived only because of local governments who stepped in with indirect support, which included preferential land deals, financing and even procurement. But that lifeline is now being cut. China's new 5-year plan signals a shift away from propping up small and unprofitable players, with policy focus turning towards better performers and scale efficiency. The timing could not be worse or smaller for smaller brands, that is. China has more than 100 electric vehicle makers, even as total EV sales have reached 5.46 million units in the first half of 2025, and a record number of electric vehicles were exported from China. Most of these companies sell fewer than 100,000 vehicles a year. Intense price wars have only accelerated the crisis. Fierce competition for market share led to price cuts of 20 to 30% through 2024 and 2025, squeezing margins across the industry. EV makers have been burning cash to fund research, new models and international expansion, even as losses have been mounting. And with no new support, failure of quite a few of these firms appear increasingly likely. In fact, even well-known names are struggling. NIO continued to post negative margins of around 31% on its premium vehicles through late 2025. Xpeng and Zeekr managed to narrow losses in the third quarter but still lost hundreds of millions of yuan despite revenue doubling between 20 to 31 billion yuan. Only a few giants stand firmly. BYD posted a $5.5 billion profit in 2024 on sales of more than $100 billion. Geely reported a 59% jump in profit in the third quarter of 2025, selling over 100,000 vehicles. With survival at stake, consolidation is now seen as inevitable. Analysts expect state-led mergers and acquisitions to cut the number of EV makers by as much as half by 2027. Weaker brands, particularly those with limited export presence, could be absorbed by stronger groups. Consolidation could improve profitability in the long run. Shared platform and common parts and even streamlined supply chains may actually push profit margins from around 5 to 10% to above 15% for surviving players. But risks remain, which includes trade barriers in overseas markets such as US and Europe, where tariffs could hit Chinese EV exports hard. As 2026 approaches, the real options that remain in sight for a lot of Chinese EV makers are merge or shut down.